Welcome to Modeling Monday, where I examine a real-world financial situation using Microsoft Excel. Today we're going to look at a long-held belief amongst investors. Should investors sell in May and go away? This examines the belief that the stock market performs very poorly during the summer months. Well, let's take a look and see what we find. We will begin by getting data for the S&P 500. So I'm going to use a free resource and go to Yahoo Finance. The web address is finance.yahoo.com. In this box, we're just merely going to type in S for lookup, and the third one down, you'll see S&P 500. The symbol is the caret symbol, GSPC. So I'm going to click on that, and that's going to bring up the S&P 500. And on the left side, we're going to click on historical pricing. This is going to bring up all the historical prices going back to 1950. We're not going to need all this data, but we're going to download it. Better too much than enough. We're going to slide to the bottom, just rolling down, download spreadsheet. Going to wait for the, and then I'm going to open the table. So then all this opens, and here's our data. And we'll see. We'll use the last date, which is 5/13/2016, going all the way back. I'm just going to hit end and the down arrow to 1950. Now Control Home will take us back up to the top. So there's a lot of information here we don't need. We're most interested in the closed column, which is column E. So let's delete columns B through D, and delete, and then C through D, and delete. Now we have the daily close for the S&P 500. Next, we're going to use a couple of formulas that are going to help us in our spreadsheet. First is going to be month. The next will be year. The formulas are pretty simple, and the formula for month is month. So our reference is going to be the date, and that'll tell us what month of the year. Since May is the 5th month of the year, the formula will return the number 5. Year works in the exact same way. I'm going to reference cell A2, hit enter, and that'll give us the year for that particular date. These two cells, C2 and D2, we're going to highlight and double click and watch it go all the way down. This will come in handy a little bit later on. Next, we're going to get month-end data. And we're going to start this by putting in the first month-end date we have, which will be 4/29. In this case, there are 30 days in April. However, there's only the 29th was the last business day, so we'll use 4/30/2016. Next, we'll do the next month, 3/31/2016. From there, we're going to highlight those two cells and drag this down. So I'm going to go, I think 30 years of data is probably good. So let's get monthly data all the way down to 1985, the end of 85. So let's go December 31st, 1985. Excellent. That's going to give us all the monthly data. We'll go to the top. So I'm just going to call this month. And this, I'm just going to put SPX for the S&P 500. So now we're going to use a VLOOKUP as the formula. So equals VLOOKUP. And this is going to vertically look for a particular characteristic, or in this case the cell, which we're going to look up. The lookup value will be G3. So I'm going to look for the information to the left, where we highlighted each individual date and the closing date of the S&P 500, the particular level. And next, let's go to the table array, and this is going to be this information right here. So it's going to look for the date 4/30/2016 in column A and match us everything that's in column B. So we're going to hit a comma, and now we're going to look for the column. What number is that column? There are 2 columns, therefore we want column B, which is column 2. Next, it's going to ask us whether true for an approximate match or false for an exact match. As we just saw with April, there was only 29. The 29th was the last business day. Therefore, we're going to put true. In the case of this formula, you can also omit this. But we're going to use true and hit enter. Now, if we copy this formula down, you'll notice that all of this data is exactly the same. You'll see that the S&P 500 is all 16.66. Now, why this happened is the fact that we have this in the wrong order. So instead of the largest numbers or the more recent date being at the top, we need it to be at the bottom. So now we're going to sort by A to Z. Another way to do this is also clicking on Data, Sort, and from oldest to newest. And it would give us the same exact information. And now we see that in column H, all these different numbers have changed. Now that we have month-end data, we can go ahead and get rid of all the data that we copied and pasted. So let's begin by highlighting G and H. Now, since H3 and downward are all formulas, we want hard numbers in there. So let's hit Copy and right-click Paste Special, and we're going to click on just Values, because all we want is the values. And now we can delete all this information. Perfect. Now we can go and begin building our chart of data so we can do our analysis. So along the top, and we're going to start in F3, we're going to number from 1 all the way to 12. So I'm going to highlight 1 and 2 as I've typed in there and copy across until I see 12. And these are going to be indicators for the month of the year, 1 being January, 2 being February, and so on. Now beginning in E4, we're going to begin typing years. So I'm most interested in 2015 all the way down to 1986. So we're going to write 2015 and 16 and then copy until it says 1986. There we go. And that, if you look in the lower right hand corner, you'll see that we've got 30 years of data, which is plenty data for an analysis. Excellent. Now I'm just going to highlight these cells and do a little bit of formatting, just a little bit, so it's easier to see what we're working on. And I missed a line, so let's just highlight, copy that, and I'm just going to drag that down. And you could have copied and pasted. In this case, I just highlighted the cells and used the lower right corner box to drag it down since there was nothing in it. Fantastic. Now we can begin filling in our chart, but we're going to need to use a couple more formulas. So in column C, we're going to put month. And in column D, we're going to use the heading year, if I can spell. Excellent. And now we're going to use the formula month to indicate which month for the date in A3. So month and A3. And just hit enter or close your parentheses. And that shows that A3 is in the month of April, the 4th month of the year. Using a similar format, we're going to use year equals year and reference A3 again, and that'll indicate which year that A3 begins in. And now we can highlight those two cells and copy all the way down. Now there's one more column of data we need to add before we can start filling in our chart. So let's select columns E and F, right click and insert. Excellent. So now we're going to calculate rates of return. So we're going to call this return and calculate the returns for each month. And we're going to do that in a very simple way. We're going to equals ending divided by beginning minus 1. So in this particular case, we can see that in the month of April, the S&P 500 increased from 2,059.74 that it ended the month in March, and increased all the way up to 2,065.30 cents. And that would be a rate of return of, extend that out, 0.27%. So that is the rate of return for that particular month. And we're going to copy all the way down. And now we can see the monthly returns. And you'll see those in column E. So now let's fill in our chart. So to do this, we can use a combination of formulas, but I prefer to use just one. And we can satisfy this by using the sum ifs. So we're going to hit equals sum ifs. And what this is going to do is it's going to sum our data using more than one criteria. In this particular instance, each month only has one rate of return. So it doesn't matter whether we use a sum ifs or an average ifs. If you go to the website, financialmodelinginexcel.com, you'll see several tutorials. One of them includes SUMIFs. So let's look at the formula. What is it that we're trying to sum? That would be the sum range. In this case, E is the column that I want to return the value of in these particular cells of our chart. So what are we going to match? So criteria range 1, and we're going to match year first. So the range is D, column D, and then what is the criteria? Well, I want to match the year. Well, what else do I want to match? I want to match the month. Month, column C, and the month 1. So in January 2015, and I'm going to make some more formatting changes here. In January 2015, the rate of return for the S&P 500 was negative 3.1%. Let's check our work. January 2015, 3.1%. Excellent. Now, we can't straight copy this down because we've referenced some cells that vary both in column as well as in row. So we're going to need to lock some ranges and enter some dollar signs. So we know that columns E, dollar sign, E, dollar sign, so that won't move. Excellent. Oops. E through E, I put that in the wrong area. Let's see, we're going to lock D because we don't want that going anywhere. And then G4, so we want this to be able to go down but not across. So we'll lock the column C through C. And then H3, and which really should be H3. C through C. There we go. Oops, I put it in the wrong place. There we go. And now it shows 3.1 again. Now if we copy that all across and then double click all the way down, now we have the rates of return. Now that we have the data here, let's go ahead and just use the average function to get a simple average for each month over this 30-year period. So in H35, we're going to use the formula average, and then select, hold on my N key, up, and hit enter. And what this will do, this will show the average rate of return for every month. And if we look at this period of time, there are several months that show negative returns. One is June, one is August, and one is September, all negative. From here, we can take it one step further. Most investors do not want to be in and out of the market 1 month at a time. In this case, we would have to sell in June, buy July 1st, sell August 1st, and then buy in October. Well, what if we just skipped these 4 months every year and just said we're not going to invest in June, July, August, or September? What would that look like? What would be our return during those months? Let's take a look at this on an annual basis. So let's go into U4 and let's calculate what, and I'm just going to do a heading, and this will be June through September. Now, when it comes to rate of return, in order to get the correct data, we have to add 1 to each number in order for it not to get very, very tiny every time we multiply it. And let me show you what that looks like. So, and there's a number of ways we can do this. We're going to do it the simplest way. So we're going to do equals, open our parentheses, and that would be June plus 1, close our parentheses, times July plus 1, times August plus 1, close our parentheses, times September. Oops, I forgot my parentheses, plus 1, and then we have to subtract 1 from that number. And that'll show us the total rate of return that happened for those 4 months. If we did not add 1 and merely multiplied those, the number would get very, very tiny. And we can't quite add them. That's not the exact property that we're seeing right now. We should do the same thing technically to get the average here, but for simplicity, I just use the average function. And then we can copy this down. So that is the average rate of return for that particular period of time over the last 30 years. We can also copy and paste this formula, and shows that the average rate of return during that period of time was cumulatively, on average, negative 0.46%. So it's pretty close to zero when you put it all together as an average. So to potentially get negative tax consequences, trading costs, things of that nature, it may make sense for the long-term investors not to sell at that point. That's not financial advice. That's just the math over the last 30 years. And we can see some significant outliers of negative 15% here, negative 23, negative 16, negative 15. So some very bad 4-month stretches where the S&P did very poorly. Well, I hope you enjoyed Modeling Monday, and I wish you all the best. Stay tuned for our next episode.